Hello, folks. Welcome to this week's market review, and of course, this week's first commentary. And yeah, happy Easter. Well, no worries really. I think the direction of this commentary would be geared towards the review part rather than discussing what market is likely to do because um, I think we talked about last week on Twitter, for example, because during the commentary last week, I was saying I do not know what the markets are going to do simply because markets trade into sell side here, right? And when market trades into objective, the only thing I want to do, I just want to wait because um, two things can happen. Markets can return back into the range, retrace heavy inside the range, or markets could just make a continuation in the previous direction, right? And if you recall, about 2 weeks back, I was discussing the high time from institutional order flow on dollar index, saying dollar index is bullish from the order flow perspective, but market structure hasn't changed, or we haven't seen any validation in terms of that bias. And the only thing that could be the reason is that the markets want to reach for some kind of objective, and it's our job as analysts to evaluate the fundamental perspective of the market and still look at technical perspective of the market. And technically, markets are still bearish on dollar index, but the high time from institutional order flow is bullish, and it's because of this reason a lot of folks don't believe, in data, for example, in complement of traders reports and stuff, because when markets begin to lag, especially when the data has been leading for a couple of weeks, there's always that gap in how they can manage their expectations, and that's why people don't believe in that. And if you're one of those folks listening to me and thinking, I thought it said dollar index is bullish, why haven't we seen? Also, I want you to remind yourself when I said market structure hasn't changed. Okay, so that's why um whenever I'm speaking about markets, I'm always talking about managing expectations, and these are real expectations. And that's why when someone says, oh, I want to learn how to define the weekly bias, I want to learn what the high time from institutional order flow is, really, you really can't learn in a single video because markets are going to present different and varying parameters and price action, and you would have to adapt. Now, how markets were moving last year is different from the way markets are moving this year. I was just speaking to a friend of mine. I was talking about how, I've learned in this Trump administration that, how markets trade would take the backseat compared to what the high time from institutional order flow is. Now, high time from institutional order flow, remember, we can define it based off of market structure, based off of quantitative analysis or qualitative analysis, that's market structure, right? I wanted to say quantitative analysis first. I said market structure first. Yeah. So we can use market structure to define high time from institutional order flow via the draw on the query, of course. So when I mention market structure, be thinking the draw on the query. Okay. So if we can define the high time from institutional order flow, what happens in market condition like this when we're in heavy trends is that you really want to focus on high time from institutional order flow rather than how the markets are going to deliver, because if you really focus on how the markets are going to deliver, that means you're having expectations of, okay, the markets are going to trade into a certain premium level, or the markets are going to reach for a certain discount level and stuff. You're going to miss out on trades, because what you should be focused on is, okay, I have an expectation on how markets are going to trade, but when markets validate the high time from institutional order flow without meeting the criteria for the markets to run into those objectives, I'm going to adjust to price action. That means I'm going to leave my feelings outside and I'm going to get in on trades. How I feel doesn't matter, because when markets validate, the high time from institutional order flow, possibly markets are hitting levels you do not see. And that's why we always say everyone is a genius in hindsight, because in hindsight you can see markets key off of levels that you know about them, but when they were forming in real time, you could not adapt to current market condition, and you're like, okay, possibly they're still going to do this, possibly they're still going to do that. And that's the reason why the mentorship series is very, very important, really. And that's also the reason why, really, I'm thinking, should I continue the mentorship in the sense that there are certain lessons that I think I'm going to omit, and it's not going to be useful for it for the developing student, because the average trader, especially from sub-Saharan Africa or from the third world countries in the world, however, whichever country, you know, they are greedy. And why are they greedy is because they are undercapitalized first. They have little capital they can trade with. And because of that, they are under the illusion of, well, I can turn this money to $1 million. Now, is it possible? Yes. But is it difficult? Extremely difficult. And why is it difficult? Because they believe that they are going to go into the 5 minutes time frame and trade consistently, and they're going to make so much money, and which is very false, because you do not have that experience and you do not have the discipline. And the only way you can find consistent profitable setup is if you're trading off of the high time frame. The high time frame chart is the easiest way, because you can, if you look at the mentorship, for example, I gave 3 lessons. Those 3 lessons is a model itself. Once you watch those lessons and you watch short-term trading, you have a trading model that you can use to trade profitable, and you don't need any other mentorship. I'm really serious. Okay, because the kind of content I'm creating is contents that, they are that's that I don't think I can improve on those lessons, except if you give me probably 5 more years, because I know I'm still going to get better at trading, and I'm going to develop new strategies and techniques I can use to, you know, trade this market more efficiently. Because I've always been saying it, I'm not learning anything new about the market. I'm learning more about the things I already know. Okay, and the things I already know, I'm trying to apply them more intelligently. Okay, all of these things I'm using to trade, I've always known them for years, but I've not been able to probably, fit in them properly. And in the last recent times, in the last recent years, I've been going about these things, regurgitating the same lessons I learned for years, and thinking, okay, so this is where it applies, here is where it applies, and stuff like that. Okay, so this is very, very important. If you want to get consistently profitable quickly, you've got to trade high time frame. The stops may be wide, but really, if you're very good at defining the high time frame institutional order flow, the likelihood you're gonna make money is very, very, very high. I teach ways you can easily make money first, because how you can now get, the high risk to reward kind of trade setups and all of that is what is the direction the mentorship is headed. And that's the reason why, there's a huge gap between, talking about high time frame and now the lower time frame chart, because I want more people to see that, your edge is in the high time frame, not the lower time frame. Because the lower time frame gets your periods you simply cannot control. Is it period you're going to be missing setups because markets are trading overnight? Is it periods when the markets are in consolidation? And what are they doing in consolidation? They are probably just consolidating at, a high time frame key level, a 4 hour level. That's where the consolidation is going on. And you're taking trades off the lower time frame, and the consolidation is going in for 3 days. For example, when we get to Euro USD, we're going to see Euro USD from last week, because I made a call on Twitter last week, and Euro USD consolidated for 3 days on the same key level. And if you think about it, if you go on day trading setup and stuff like that, you probably take a loss on one of those days, and then you'll probably not trade on Friday. And market began to move on Friday, because Friday was bank holiday, and you wouldn't want to trade because you don't know what is going to happen. And Monday too is also bank holiday, and you're not supposed to trade today, and you're going to take a loss on one of those days. You're not going to trade on Friday because you're sticking to your rules, and it doesn't make sense to trade on bank holiday. And then the markets are now explosive today, and you're going to come to the chat and say, or you come online and see people posting profits, and you're going to come to the chat and say, why didn't I trade on a bank holiday? And the next time you're going to trade on a bank holiday, the markets are going to destroy you. They're simply going to destroy you. And you'll be like, this is why I don't trade on bank holiday. But why do you trade on bank holiday? So the only way you can beat the market is to trade the high time frame. Because when you're looking at the market from the high time frame perspective, you don't concern yourself with bank holidays. You don't concern yourself with kill zones. You just concern yourself with key levels and the high time frame drawn liquidity. It's as simple as that. So the number of variables you're considering when you're trading the high time frame, they're smaller compared to the variables you consider when you want to trade the intraday charts. For the intraday charts, after defining the high time frame drawn liquidity, you define key levels, you define market profile. You want to see what the previous session is doing. You want to define if the next session is high probability. And market profile and profiling is the next lesson, the module, and the mentorship. Very, very interesting lesson. I mean, if you think about it, and when I present the lesson and you really, really think about it, and you go into your chat and you study, you what I'm doing, the other way I can use to rename the lesson apart from market profile and profiling is, evaluating lower time frame probabilities. That's the ideal, title for the lesson, because that's what it is. Now, with all of the rants, it's not really a rant because I'm really speaking to a lot of folks here. It's not rant because it doesn't concern me. I'm literally telling you what, your psychology is as a day trader, because I am a day trader and I've been day trading for years and I know what it is, the kind of psychological barriers it is to be a day trader. Especially if you're like a average trader who thinks, is going to make a lot of money off of Forex, which is very true. And you're going to do it in the confines of your room, which is also very true. And you don't have any online visibility, no exposure. You want to do it off of your room, and your parents are probably not so. You're just the average parent, the average African parent, or the average parent around the world. You can make ends meet, but they can't provide capital for you to trade and stuff like that. How many years do you think you're gonna spend doing it? And that's why a lot of folks subscribe into, what they call flipping. You get, and the truth is, when you lose that capital, do you know how long it's going to take you to get capital to trade again? And you will say you want to leverage it on a single trade. And that's why the only solution is prop firms. But before you can trade prop firms, you need to really have your own trading system. And the only way you can beat the proprietary firm is if you're trading off the high time frame, because they know a lot of day traders will fail. A lot of day traders will obviously fail. It's how the markets are designed. The markets are designed for you to fail. And it takes intense discipline and knowledge for you to navigate the charts as a day trader. And you also acknowledge the fact that every day is not day trading. And you also acknowledge the fact that if you're day trading, you are likely to miss on a lot of setups when you're starting off, obviously. And you might have to enter more than once, because you can make a mistake and get stopped out, and you have to go inside the market again, because nothing has changed on the high time frame. Because nothing has changed on the high time frame. So it means you can be taking a loss on the intraday time frame, and it doesn't mean you're wrong on bias. You probably did something stupid, or the markets were in consolidation, and markets are in consolidation, your stops are susceptible, and they can run your stops. And running your stops only mean that it's a turtle soup and the move is likely to ensue now. It's that crazy. So this is dollar index, the monthly time frame, and the reason why we're on the monthly time frame is because I want to throw your eyes. I want you to see this. You can see this monthly gap here. If you extend it here, this is monthly fair value gap, an old monthly gap. Okay, and it's pretty important that you see this monthly gap, because what we're going to do on the lower time frame is we want to see how this monthly gap would influence, how we perceive the markets on the intraday charts. That's and the daily time frame, of course. Because when I posted dollar index on Twitter, which we're still going to check, there was a lot of comments and everyone was sharing their opinion about what they think about the dollar index. And the truth is, it's very valid. But also, like I said, in hindsight, you begin to see that, why didn't I adjust it? Why didn't I see that? And that's why the best way for you to view the market is from the perspective of the high time frame drawn liquidity, which is the high time frame institutional order flow. And after that, The next thing you want to be looking for is how the markets can validate that bias. So you can simply just go in. So now we have this fair value gap here, and you can see how the markets are trading through this gap. And you can look closely here, you can see there's a discount gap. So when markets trade into this old high and market began to give more downside, obviously you can see the markets are likely to return into the pockets of liquidity here. That's this BC here, the buy side imbalance, sell side inefficiency here. And this is the drawn liquidity on dollar index. And we're gonna, yes, we have that one there. And we have this one here on the daily time frame. Okay, weekly time frame too. So we have this as a drawn liquidity, and when markets trading here, I think it's something you want to see from the weekly time frame. How the market closed last week. Okay, you can see last week the market closed below this monthly fair value gap. So the markets are likely to retest this gap, not necessarily retest the gap, but closing below this gap only validates this becomes an inversion fair value gap. So this becomes the new resistance level. And mind you, you can see this low here. You can see this low here. If you extend it forward, of course, we're going to extend into the daily time frame, and we're going to see what's really going on there on the daily chart. So you can see we have an old low here, and we can literally use this old low for resistance. And not just this low here, the markets could have probably traded into this old weekly low here for resistance and return into this gap here. It's very, very possible. But in periods when we are in trends, you know what trending market is? Trending markets, in terms of the weekly range, is the high of the week is going to form. There's going to be a tiny tail here. Okay, the high of the week will form quickly, and the market delivers the bodies of the candle, the range expansion. That's what trending weeks are like. So if markets are in a trend, the likelihood they make a deep retracement before making the range expansion is very, very low. Okay, you can imagine periods like this, you're bullish and markets are in your trend, and you're probably expecting the markets to return into this consecutive down candle. Markets wouldn't. But how are you going to manage your expectation? Well, when you see a change in the state in delivery, because the drawn liquidity here becomes this gap here, high time from institutional order flow is bullish, we have a change in state in delivery. So on this weekly time frame, is it okay to anticipate markets possibly trading into this consecutive down candle? It's very okay. But can the markets trade it? Well, the markets can trade and markets cannot trade. Now, what's more important? The high time from institutional order flow. How do you adjust to that when markets validate that order flow? How does the market validate that? Via the change in state in delivery. So on the weekly time frame, we have this down candle here. We have the drawn liquidity here off of the monthly time frame, and we saw how the markets close. So if you go in, or if you are going through the market last week, and you have the expectation that the markets are likely to trade into this gap first before delivering more sell side, well, it's likely to be low probability because there's a key level you're not seeing. And because you do not see that, it reduces the probability that markets are going to trade here. But in hindsight, you're like, oh, oh, okay, this happened, that happened. But your price action on subordinate time frame that can lead you to anticipating the markets are likely to attack sell side first. For example, when we look at daily time frame, we can see price action. The price action we talked about on dollar index on Twitter. We can see this daily fair value gap, and you can see this fair value gap overlaps the weekly old low. Now, if someone sees it now and they'll be like, oh, so this is the reason why market is selling. But obviously, why didn't you anticipate that markets are likely to trade like this? Because on Twitter, I was talking about dollar index last week, and I made a post That was on Wednesday. Yeah, that was Wednesday, really. You know, not too much drama here, just talking about DXY. You know, that was 16th of April during the London session because we woke up overnight and saw the markets expanded overnight. And this was the height. This is the institutional order flow entry drill, where I made explanation about what institutional order flow entry drill is. Um, Someone asked a question what the institutional order flow entry drill is. I said primarily there are about three ways the markets can trade inside an inefficiency: institutional order flow entry drill, consequent encroachment, and 100% fill. Now, when you compare institutional order flow entry drill, that's this. When you make it in comparison with how markets can trade inside an inefficiency, you'd see that the markets are in a hurry to reach for an opposing liquidity pool. Okay, and because of the markets are trying to reach for this opposing liquidity pool and not trying to trade inside the range of this inefficiency, so the markets trade a bit into this gap and validate the high time from institutional order flow. And how is the market validating that? Well, you see it here, but in the 4-hour time frame. Once the trade above previous this high, there's a change in the state in delivery. And as soon as markets changes its state in delivery, this consecutive up candle becomes the bullish or the bearish order block. Meaning now the markets are traded into previous this low. You can see closely here, there's previous this low, which is an objective. You want to wait. And you want to wait because markets are likely to return into the range where this key level, and what's this key level? The bearish order block. But when you move it to the left a bit, this becomes your breaker. Why is it the breaker? This last down candle prior to the run of liquidity at the previous this high, that's the breaker. And that's the same thing I was talking about here. When someone say, hey, hello, Settle, can you clarify with chat example the difference between the bearish breaker or the breaker block and the mitigation block? I simply pulled out this same chart and say this is a breaker. This same chart. I mean, Settle Black is a big flex. Saying that this is a breaker, like as though I was doing it in a very subtle way of saying this is a bearish breaker you can sell from, and talking about what the mitigation block is. This down candle here is mitigation block. But if I overlap this consecutive up candle, this is a bearish order block. But here it's a mitigation block. So you see from the lessons we've been treating, I've taught bearish order block, the consecutive up candle prior to the change in state in delivery. I've taught the mitigation block. If you move it to the left of it, that's a mitigation block, especially if we have a failure swing. What's a failure swing? If this swing point fails to run above the previous high, or if it's in a bullish sense, if it fails to go below the previous low, that's a failure swing. I've also taught the breaker. When we have a run on liquidity here, that's a breaker. And I've taught the order block, the bullish order block, the bearish order block, and everyone knows the fair value gap. And I've taught the rejection block, and I've taught old highs, lows. I've basically taught the PDRA matrix without actually teaching the PDRA matrix in a single lesson. So just with using the bearish order block, we can define, the gaps, the breakers, and also old highs. And I also talked about the fact that when the high time from institutional order flow is bearish, a shift in market structure. This bullish shift in market structure is likely what? A torso. So I was educating on, high time from the institutional order flow entry drill and saying, think of institutional order flow entry drill as a price delivery mechanism the algorithm uses to reprice into target as though it's in a hurry. I mean, that's the reason it couldn't return to the midpoint, because they're in a hurry to reach for an opposing liquidity pool, and that's why they just trade a little bit into the inefficiency and then validate, the high time from institutional order flow. Now I said depending on the time frame though, but this one's validated by the 4-hour market structure shift or the change in the state in delivery. And he was asking, so the body of the candle close below the bullish of that bullish candle can be called an OB and validates the fair value gap being filled. Now the question is, now that we see a change in state in delivery, that's this candle closing below this consecutive up candle, does it validate that this fair value gap has been filled? Yes, it validates this fair value gap has been filled. So if you're having any expectation whatsoever that markets are likely to trade into probably 140, 150, it's likely, it's low probability, because the market now has validated that they are locked in on previous weekly low. And why are they locked in on previous weekly low? Well, last week when we're looking at price action, I was talking about, you can revisit the commentary last week. I was saying that last week is likely to be bearish simply because we had a bearish candle in the previous week. So because this is bearish, my weekly bias is bearish, even though we trade below sell side. Because below sell side, two things can happen. Markets are likely to make a continuation, or markets are likely to return into the range. But since market structure is still bearish, and we looked at Euro USD, we looked at Euro USD from the 6 month time frame and said there's a premium premium monthly fair value gap Euro is likely to reach for. So because there is that on Euro USD, and that's the drawn liquidity, so it's likely, looking at this weekly candle, validates already my weekly bias as bearish. So now that I have a weekly bias bearish, and we have institutional order flow entry drill here, they trade a little bit inside this inefficiency, and there was a change in the state in delivery. Okay, there's a change in state in delivery here, a market trade into previous day's low. What's likely to happen? Well, when they return back into this order block or this breaker, I'm going to sell, because I don't know how the markets are going to unfold, and wait for the markets to reach for objective. And that's simply, you can see, that's simply the trade I shared this morning, because my colleague called me this morning and said I should check dollar index, because we're discussing dollar index during the weekend, and saying we are likely to see expansion at the opening because of all of things going on in the United States, China and stuff. You know, there was a lot of things going on in financial markets, and dollar is still taking a heavy toll from all of the tariffs and stuff. So, and that's why you'd see that I got in on the trade when markets return into the 4-hour breaker, a bullish at the block on Euro USD, and I held through the consolidation. So you can imagine, if you're using this brokerage and you want to trade off of this 4-hour gap, well, you're not going to get a feel, because the markets never trade into this gap. And why you market trade into this gap? Well, there's already a key level, okay? And markets can spend a lot of times, and that's what I was talking about, mitigated levels and stuff in Forex. I don't think of it that way, because markets can retest the same level multiple times. They can spend time there. That's consolidation. And you can't, nothing prepares you for the consolidation. And if you think you're going to be smart and you're going to follow day trading models, your day trading models will delimit you from participating in long-term moves, because there are periods when the markets are likely to move. Those periods are probably not in favor of your day trading model. When I mean day trading model, I don't mean entry pattern. I'm not talking about your entry pattern and stuff. I'm talking about how you're defining high probability day trading conditions, right? If you're defining those high probability day trading conditions, you're likely to miss out on a lot of trades, and that's why you want to be focusing on you want to be focusing on short-term trades, swing trades, and also day trades. You don't want to think yourself, I'm a born scalper, I don't have a lot of patience. You can train yourself to be patient. The only reason why you're not patient is probably you want to make a lot of money quickly, so you have to retrain psychology to thinking you can wait. So, looking at dollar index, markets returning to the bearish order block, spend a lot of time in this bearish order block. Now, when markets returning, someone can say, "Oh, you're gonna trade into this gap and stuff." Well, no. This becomes a breakaway gap. Now you can see how markets traded at the open here. You can see they return into this breaker. Oh, why is this a breaker? Well, if you look closely, Um, if you look closely here, you can see there's a short on high, there's a tiny bit of fair value gap here, and this down candle came before this consecutive up candle. So the breaker is going to take priority first, not the bearish order block. And why is it going to take precedence? Because we now have an opening gap. Because when the markets open and gap lower, markets created this gap. So the markets are likely to return into this gap first, into a PD array, this old low here. And what's this old low? It's the breaker. But say we had this down candle here first, well, we'll have to reference the down candle. For example, look here. As soon as the markets created this consecutive up candles and this became a bearish on the block after I changed the state in delivery, you can see markets hasn't created anything else. There was no inefficiency, there was nothing. So it's just the bearish on the block and market sweeping liquidity here. So what's the killer of the bearish on the block? But if you look closely, this you have to see differently. Markets created an inefficiency, and in the PD array matrix, the fair value gaps, the inefficiency comes before the what? The bearish on the block. But the breaker comes before what? The inefficiency. Because you're likely to see the breaker first before the inefficiency. Look here. You can see there's a breaker here before what? This inefficiency here and this inefficiency here. That's PD array matrix. That's probabilistic thinking. But of course, this is it. And there's nothing really anyone can say about it. The market is trading into the drawn liquidity previous weekly low, and that's why I collapsed my trade on Euro USD. I mean, I've suffered enough on that trade, holding through the consolidation. So I closed Euro USD. I left my positions on on gold and silver and on GBP USD. I'm gonna hold to see, dollar index trade into sell side here objective. That's the monthly fair value gap. So this is the drawn liquidity for this week, because the weekly time from last week, we closed bearish, and of course we're respecting levels on the weekly time frame. So the drawn liquidity this week still bearish, and we're gonna see how the markets trade. Now someone would say, okay, how is the markets going to trade there? Well, the way the markets are going to trade into objective is obviously from here, the 4-hour bearish breaker. But of course, you're a day trader, so you're going to miss this and you can't participate in this move. So, and whatever price action that on the intraday time frame that's likely to form to take us here, it hasn't formed yet. And I'm not the type of trader that say, okay, this is inducement and the markets are probably going to trade into a premium. That stuff is bullshit. It will only play out in periods when markets are consolidation. Okay, and apparently, if you're looking at the high time frame, because this is the high time frame, it's not how it works, really. That's not how it works. Then you have to be playing around lower time frame, start looking for liquidity in quotes on the lower time frame, and somebody goes through years trying to identify liquidity, and someone say, okay, I can teach you how to identify the perfect liquidity markets are going to reach for. You see, you're just in a rat race, really. If you're trying to find the best strategy on day trading, you're just simply in a rat race, because you'd say that you're still missing out on a lot of moves, because you don't know how to manage expectation during trading markets, because you don't understand price action. And what everyone is teaching is some sort of strategy, and they say strategy is logic. That's what everyone's saying now. When they mentions SLK and stuff, everyone's saying the same thing, just rebranding new contents to sell mentorship and stuff. And you're just gonna stay in the rat race, really. The only way for you is to see the markets the way the market really is. Just see it for what it is. Leave concepts aside. Just look at candlesticks and see the market for what it is truly. Just see it for what it is really. So on Euro USD, apparently last week, same thing with dollar index, there was a change in statement delivery. This brokerage here returning to this gap that wasn't on that brokerage. You can see how the brokerage pricing can really make you lose your shit. day trading is crazy. And last week there was a change in statement delivery towards that was the New York session. I was looking at a market and everything. This already gave off what the markets are likely to do at the open. And I think I was looking at the setup. I was looking at this fair value gap here, after the market did a change state in delivery here, return here, and now that's obviously bullish, and we were, towards the launch in New York. There was a fair value gap here, so this was like very insane risk to reward. I didn't trade it because bank holiday, not going to trade it. Assuming it was no bank holiday, I think I have a chart somewhere. I don't open my Telegram to show you, just show you sale of stuff, my journal and stuff, and I don't want to do that. Okay, very insane risk to reward because literally here, and the target, this was the objective. Okay, and yeah, that's 8.5%. So someone will be saying, "Oh, this is kind of trade I want to get." But your day trading your day trading models would not allow you getting trades like this because it's bank holiday. How are you going to trade? You're possibly not going to trade, except if you just want to risk it. But if you're managing your capital already, you're not going to take this trade. And currently, the trade is running about 7.8 hour, and you can see the logic behind. After this consolidation, market ran liquidity here. If I did a change state in delivery here, return to this gap, okay, in New York, and then markets are returning to this fair value gap here. Now you can get in on this setup here. You can also get on the setup here. I didn't see this one, okay, because I was not watching them. When I came to chat, I saw this one. I'm like, damn, I can get it, but I just didn't get it. So you can see, ideally, in the ideal scenarios during the week, I'm going to get in on the 4 hour trade here, and I'm going to also get in on the day trade here. So for the risk to reward that this doesn't compensate, this will compensate for the risk to reward. And that's how I want everyone to think. I want you to think that you can't always get the high risk to reward from the market. I want you to think that you subject yourself to the opportunities the market presents to you. And when markets present other opportunities favorable to the type of trader you are, you subject yourself to that opportunity. So here, you're looking at it from the perspective of the high time frame, markets are in consolidation. You're not worried because you're off of the high time frame. And when the markets begin to validate, because now, a run below an old low, when markets are bullish, that's a Tory soup. And when the market validates that bullishness again, you want to go in. But on Friday, dollar index wasn't moving. So I didn't want to go in blindly on just Euro USD, and dollar index wakes up during the weekend and just smashes the other side, because this can go either ways. This can go either ways. Markets can revisit these lows. Can someone say, "Oh, relatively equal lows"? Yeah, these are relatively equal. Okay, markets can just go in the opposite direction, and then I take a loss, and it's not funny anymore. No, really, when the only way anybody can really improve in trading is if you're really real with yourself. You have to be real, and that's one thing I'll keep on saying and telling you. You just have to be real with yourself, real with your limitations, real with what the markets are really doing. Can you always get this kind of trades? No. But do this kind of trades form? Yes. Do they form every day? No. Setups form every day? Yes. Are those kind of setup adjusted the type of trader you are? But probably, if you're a day trader, no. But if you're every type of trader, yes. Sometimes scalping opportunities are presenting, sometimes long-term opportunities are presenting, sometimes day trading opportunities, high probability day trading positions or day trading entries will present itself. But sometimes your models, your strategies will limit those things, especially if you're a day trader. Because if I'm to day trade, I need to see certain things, certain conditions being met. I want to look at the time of day of the week, the EC. I want to look at all of that stuff. So We're very close to objective on Euro USD. This high here, okay? So that's what I'm eyeballing now, this high here. And that's what we're seeing. And a little bit of study on last week price action. You can see this was an old volume balance. Market closed above. So showing that we're still bullish since we're still above this volume balance. Now, if you look closely here, I think this volume balance market made a retest of it last week. And if you check where the retest was made, you'd notice that exactly here, it was made here. So market is keying off of what? A high time frame level, an old volume imbalance, and overlapping what? This daily fair value gap. Initially last week, I was thinking that there's a possibility market returning to this discount gap. That's what I was thinking. I was talking about previous weekly low on dollar index, and that previous weekly low was this candle's low. That's what I was thinking. But as soon as the week progressed and we had a change in the state in delivery, what comes in first? The high time for institutional order flow. Wherever my feelings may be, it's no more valid because market has already validated the high time from institutional order flow. So my feelings of how the high time from institutional order flow should pan out becomes very invalid. So you look at GU, for example, okay. Last week price action on GU, the previous week was bullish, and this week is likely to also be bullish. And now I'm thinking GU would run buy side liquidity resting above here. And for the daily time frame, okay, this was an old high on the daily chart, like a breaker, high, low, high, lower, low, market around liquidity. Yeah, this is a breaker. And since G was bullish last week, you notice that Monday was bullish. And if Monday is bullish, what does that mean for the weekly bias? Well, this is validating the weekly bias as bullish. So Tuesday, likely bullish. But by Tuesday, I wasn't sure personally what dollar index was going to do. Okay, I wasn't sure. I had to wait for dollar index to validate the weekly bias. So by Wednesday, there was a change in the state in delivery on dollar index. So what does it mean for the majors? Well, I'm looking for longs across the majors. So on Wednesday, I'm going in on Euro. Then on Thursday, GBP USD trade into this old high, previous day's low. Now, institutional order flow bullish. Market trading into the previous day's low, into an old high. Support, bullish. DXY is validated weekly bias, so I'm bullish. Old high for support, bullish. Would I think the market will trade in? No. Would I think the market will trade into this gap for a continuation? No. Why not? Because Monday's trading already validated the monthly bias. Sorry, the weekly bias. So whatever expectation I'm going to be having is going to be within Wednesday to Monday's range, not below Monday's range, because we shouldn't go below Monday's range. Monday has already established weekly buy, so we can't go below Monday's range. So that's how you want to think. When you're thinking about weekly buys, think about each day, how each day of the week contributes to the weekly buys. That's how you want to think. That's how you want to manage your expectation. That's how, oh, damn, I'm looking at G and I'm saying how much I'm floating. Probably running over 100 pips now. So you can see we had a run below previous day's low, totally soup into this old high. And if you check the 4-hour time frame, you can see that's the run below this low on the 4-hour time frame. I was still very conservative because why? I wanted to see 4-hour validated change staying delivery. So you can see this candle closed above this consecutive down candles, the body. That's a change state in delivery. So when the markets return back here, that's your order block. That's your buy. You can either buy this candle aggressive because the markets may not return back into this order block. But if you want to be conservative, you can just wait for the market to return back into this order block. What's the order block? This consecutive down candle. Can the market return into this exact down candle? Yes, it's very possible. But you can see the market made a retest of this down candle. So if I want to manage my expectation, I'm going to buy this order block here, or I can wait on the lower time frame and increase the probability of my trades. So you can see here on the 12 time frame is the same thing. This consecutive down candle. Market didn't close here above. If market had closed above, by the next candle, stops here. I don't care. I don't care about stop loss. I just plot. Where is the market reaching for? Where's the market reaching for? Oh, the markets are reaching for some weekly, monthly objective, and I'm going to take the trades like that, and hold for objective, and that's 5%. Someone say, "Oh, you're using a 35 pip stop loss." Oh, you are not in the trade. Are there ways I can go in? Yes, there are ways I can go in, but what's market condition? You can see all of this back and forth. I don't trust the intraday stops. I personally wouldn't trust my intraday stops, especially for the fact that we're heading towards the portion of the week where there isn't trading, the bank holiday, because of the holidays and stuff, Easter. So I have to be very, very careful. So you can go in a lower time frame, obviously. Someone saying, "Oh, you can buy this order block." Obviously, when you buy this order block, it's insane risk to reward. Insane risk to reward. Obviously, I got in on this fair value gap, the easiest field. This fair value gap, stop loss here, and held. Because markets validated order flow here, had a gap here, stop here. So it was pretty. It was crazy. The risk to reward was crazy. So, and that's why I have this line here, because I was buying this fair value gap here and stuff, because I was on call with my colleagues and stuff. So it seemed easy in hindsight, but it takes a lot of mental resilience and really knowing what you're looking for. So we have the drawn liquidity here, possibly the market trades there. I don't know. I've taken partials on trades, waiting for the markets to reach for this high if possible. Courtesy of the fact that we're still expecting DXY to trade into target here. You understand? So this is the objective for dollar index, and it's the reason why we can anticipate more upside in foreign currencies. So that's this week's commentary. Basically, it's a market review because markets are expanding, and when markets get here, we simply want to wait. So I hope you found this one insightful. Until I catch you in the next one, and I think the next one is going to be the mentorship, because I would have to upload the mentorship sometime this week. And if you got to the end of this video, don't forget to like, subscribe to my YouTube channel if the first time you're seeing this video, and share with your friends, community, recommend my channel to folks. I see a lot of people recommend my channel on Twitter, and I'm so grateful. I'm so happy to see that people recognize my work and sharing my stuff to everyone else, and it's been fun. Really, it's been fun. So until next time, be safe.